This is the summary of National Finance Unit 7, qualifying and closing the loan. Loan qualification revolves around the buyer, the property, and the title of the property. Qualifying the buyer means verifying they have the ability to repay the loan by looking at their mortgage to income ratio, assets, liabilities, debt coverage ratio, and attitude. When qualifying, the property lenders consider a variety of factors including the type of property, location, area zoning, value range, neighborhood, actual and effective ages, remaining economic life, condition, special clearances, and overall marketability. Qualifying the title includes reviewing the abstract and opinion, chain of title, and title insurance. These terms should be memorized for the examination. 1. Non-recourse loan is when the borrower is not held personally liable on the note. 2. Non-recourse clause states the seller of a security is not responsible if a borrower defaults. 3. Default is the non-performance of a duty or obligation that is part of a contract. 4. Conditional approval is a written pledge by a lender to lend a certain amount of money to a qualified borrower on a particular piece of real estate for a specified time under specific terms. 5. Underwriting is the analysis of the extent of risk assumed in connection with a loan. 6. Appraisal fees are fees typically based on time and expenses to appraise a property. Fees are never based on a percentage of the appraised value. 7. An estoppel certificate prevents a person from asserting rights or facts that are inconsistent with a previous position or representation made by act, conduct, or silence. 8. Exculpatory clause is when the lender waives the right to a deficiency judgment. 9. Impounds are a fund of the buyer's money that the lender sets aside for future needs relating to the parcel of property. 10. Disintermediation is the process of individuals investing funds directly instead of placing money savings institutions. 11. A short sale occurs in lieu of a foreclosure. In the end, the lender agrees to accept a loan payoff amount that is less than what is actually owed. Closing a loan can be done two ways. The first is with the buyer and seller face-to-face. All parties to the transaction are present and the closing is conducted by a settlement agent. The second way is closing in escrow, where a third party acts as the escrow agent for the buyer and seller and conducts all the closing activities. The settlement agent does the closing, calculates the costs involved, and fills out the closing statements. A settlement agent could be an attorney, a real estate broker, a closer from the title company, or a lender. Many states charge a transfer tax when a property changes possession. These can be paid by the seller or buyer. Many governments use transfer taxes to collect reliable data on fair market value.